Yes, sir, Madam from Golden Gate University. My name is Đức Tùng from Vietnam. Today, we'd like to do a presentation about my assignment of course 6, Corporate Finance, and Module 5. So I'd like to share our screen so that you can see our presentation. Okay. So right now I'm sharing screen and I open the file. Okay. So my name is Đức Tùng and I choose the company Walmart with a ticker symbol is WMT. The stock exchange where chosen company trade is in New York Stock Exchange with the recent stock price at 85.35 and on 14th of March in 2025. Okay, there's two competitors of Walmart, which is the Target Corporation and the Costco Wholesale Corporation. Okay, why choose Walmart? Because Walmart is a stable company with a long history and transparent financial data. Walmart consistently pays dividends, aligning with the project requirements. Or Walmart faces strong competition from major retailers like Target and Costco, providing ample opportunities for comparison analysis. Okay, so Walmart is one of the world's largest market influ- influential retail corporation, founded in 1962 by Sam Walton. Walmart has grown from a single discount store in Rogers, Arkansas to global retail giant with a presence in over 25 countries. The company operates in under three main segments: Walmart US, Walmart International, and Sam's Club. Walmart is even known for its everyday low price strategy and has made it a dominant player in the retail industry. So Walmart history is marked by rapid expansion and innovation. The company went public in 1970 and has since become a leader in retail, leveraging its massive scale to offer low price and a wide range of products. Walmart's outlook remains strong with a focus on e-commerce growth, supply chain efficiency, and sustainability initiatives. The company is investing heavily in technology, including automation and data analytics, to enhance customer experience with operational efficiency. Walmart's annual revenue is $500 billion, making it one of the largest companies by revenue globally. So, by industry description, Walmart operates in retail industry, especially in the mass merchandising and e-commerce sectors. The retail industry is highly competitive, with key players like Amazon, Target, and Costco. The industry is characterized by low profit machines, with high volume sales and constant need for innovation to meet changing consumer preference. The rise of e-commerce has transformed the industry, pushing traditional retail like Walmart to expand their online presence and integrate omni-channel strategy. Walmart competes in both physical retail and online markets, offering grocery, apparel, electronic, and more. So, recent major news event: expansion of drone delivery service. Walmart announced a significant expansion of its drone delivery service in partnership with DroneUp, Flytrix, and Zipline. This initiative aims to deliver products to customer homes within 30 minutes, enhancing convenience and competitiveness in the e-commerce space. The second is sustainability commitment. Walmart pledges to achieve zero emissions across its global operation by 2040. The company is investing in renewable energy, electric vehicle fleets, and sustainable packaging to reduce environmental footprint. This commitment aligns with growing consumer demand for environmentally responsible businesses. So Walmart is a retail powerhouse with a rich history and strong outlook focused on e-commerce, technology, and sustainability. The company operates in a highly competitive retail industry where innovation and adaptability are crucial. Recent news highlight Walmart's effort to expand drone delivery service and commit to sustainability, reflecting its focus on customer uh, convenience and environmental responsibility. So the third part is financial statement and ratio analysis. The key highlight from financial statement using Walmart lazy financial statement. Okay, the highlight one is decline net income. The Walmart net income decreased from about like $13,000 million in 2022 to about $2,680 million in 2023. So this decline may be attributed to rising operational costs, increased competition, investment in e-commerce and technology. Despite the decline, Walmart remained profitable, demonstrating its ability to manage costs effectively in a challenging retail environment. Highlight two increase in total revenue. Walmart's total revenue increased from about $572,000 million in 2022 to about $611,000 million in 2023. The revenue growth highlights Walmart's strong market position and successful omnichannel strategy, which integrates physical store with e-commerce. This growth is particularly noteworthy given the highly competition nature of the retail industry. So the key financial ratio. Using data from the provided table, here is key financial ratio for Walmart. You can see the current ratio, the quick ratio, the total asset turnover, the debt to asset ratio, the time interest earned, operating machine, profit machine, return on assets, and return on equity as discussed and are shown clearly on the table, you can see. But a trend analysis for two financial ratio, like profit machine, the trend is that Walmart's profit machine declined from 2.42% in 2021 to 1.91% in 2023. The declining trend indicates increasing cost pricing pressure in the retail industry. One focus on low price and investment in e-commerce may be imparting profitability. Debt to asset ratio. Walmart debt to asset ratio increased from 70.73% in 2022 to 77.88% in 2023. The rising trend suggests that Walmart is relying more on debt to finance its operations and growth initiative. This could indicate higher financial risk if not managed properly. Trend analysis for compatible company, like static ratio for target profit machine trend. Target profit machine has climbed from 5.5% in 2021 to 4.2% in 2023. Walmart profit machine 1.91% is significantly lower than targets, but Walmart's machine is more stable. Target declining machine may indicate challenges in managing costs or competitive pressures. Debt to asset ratio. Target debt to asset ratio has increased from 1.2 in 2021 to 1.5 in 2023. Walmart's debt to asset ratio is lower than targets, indicating that Walmart is stronger financial position with less reliance on debt. So we go to inclusion. Walmart is performing better than target in terms of debt management, lower debt to asset ratio, and stability in profitability. Stable profit machine. Target, while historically more profitable, is facing challenges with rising debt and declining machine. Well, part 4 is cost of debt. Debt management ratio. Debt to asset ratio is 77.88%. This ratio indicates that Walmart assets are financed by debt. Why this is relatively high? It aligns with Walmart's capital-intensive business model. The company has a strong ability to generate cash flow, which have managed its debt obligation. So the high debt to asset ratio suggests increased financial risk. However, Walmart's strong cash flow generation and market position have mitigated risk. Time interest earned is 9. This ratio measures Walmart's ability to cover its interest expense using its operating income. A ratio of 9 means that Walmart's EEIT is 9 times its interest expense, indicating strong coverage. Walmart has sufficient earnings to cover its interest payments, which is a positive signal for peers and reflect good credit worthiness. Liquidity ratio. Current ratio is 0.82. The current ratio measures Walmart's ability to cover its short-term liabilities with its short-term assets. A ratio of 0.82 suggests that Walmart has $0.82 in current assets for every $1 of current liabilities. While ratio below 1 is generally considered as a red flag, Walmart's strong cash flow generation and access to credit facilities have offset this concern. Quick ratio is 0.21. The quick ratio excludes inventory and measures Walmart's ability to meet short-term obligations with its more liquid assets. The ratio of 0.21 is low, indicating limited liquidity without relying on inventory sale. This low ratio highlights Walmart's reliance on inventory turnover to meet short-term obligations. However, Walmart's efficient inventory management and strong sale mitigates this risk. Bond rating and cost of debt capital. Bond rating. Walmart's strong financial position, consistent cash flow generation, and ability to service its debt have earned a high credit rating. As of 2023, Walmart's bond rating is AA from agencies like S&P and Moody's, which is considered high grade and reflects low credit risk. Cost of debt capital. Due to high credit rating, Walmart enjoys relative low cost of debt capital. The company can issue bonds at low interest rates compared to lower rated firms, reducing its overall cost of borrowing. Conclusion: Walmart debt management and liquidity ratio indicates a strong ability to manage its debt obligation, supported by consistent cash flow generation and efficient operations. The company's high bond rating AA and low cost of debt capital further reinforce its creditworthiness, while liquidity ratios are relatively low. Walmart's strong market position and access to credit facilities have mitigated this concern. Part 5: the cost of common equity. Calculate the beta and expected return for Walmart. Calculate beta. Input data: the firm monthly expected return is 4.04%. Market monthly expected return is 26.28%. Standard deviation of firm return is 5.17%. Standard deviation of market return is 34.53%. So step 1: calculate covariance. Calculate covariance. Okay, is equal 0.0116. Step 2: calculate variance of market returns at 0.1192. Step 3: compute beta. With the so we get the results that is at 0.1. So Walmart beta of 0.1 indicates that its stock is less volatile compared to the market, making it low risk investment related to the overall market. Expected return calculation using the CAPM formula. So expected return equal risk-free rate plus beta multiply return on market minus risk-free rate, as you can see on the screen. So the risk-free rate is 3.745%. Return on market is 315.38%. Beta at 0.1. Expected return we can calculate and have the result is that 34.91%. Therefore, this is the index for the expected return for Walmart. Comparison of Walmart beta with the comparative company. So we choose the target company. Okay, so the Walmart beta is significantly lower than target beta. Walmart beta is 0.1 and target beta is 1.05. So Walmart's low beta indicates that the stock is less sensitive to market fluctuation, making it a more stable investment. Target beta of 1.015 suggests that its stock is more volatile and closely follow market movement. So part 6 is about capital structure. The pie chart for Walmart's capital structure. You can see the common for capital structure as long-term debt, common equity capital. We first start at I show on the screen. So we have the pie chart. They included long-term debt at $28,923 million, and the common equity capital is at $83,991 million. As the pie chart, you can see with the color orange color is for the common equity capital, and the blue color is for long-term debts, very clearly as the pie chart. So the change in capital structure over the past 5 years. So the Walmart capital structure has shifted over the past 5 years with change in the proportion of long-term debt and common equity. So we have the key trends is like that. The increase in long-term debt. Walmart's long-term debt had increased from about $57,000 million in 2022 to $58,923 million in 2023, reflecting its reliance on debt financing for growth initiatives. Decrease in common equity. Walmart common equity has decreased from $91,000 million in 2022 to about $83,000 million in 2023, possibly due to share buybacks or retained earning adjustments. Factors explain the shift. Investment in growth initiatives. Walmart has increased the long-term debt to fund investment in e-commerce technology and supply chain improvement. These initiatives require significant capital, leading to higher debt levels. Share buyback. Walmart has actively repurchased its shares over the past 5 years, reducing its common equities. Share buybacks are often used to return value to shareholders and boost earnings per share (EPS). So Walmart's capital structure has shifted to higher debt and lower equity over the past 5 years, driven by investment in growth initiatives and share buybacks. This change reflects Walmart's strategies to balance growth and shareholder returns. So we go to the part 7, the WACC calculation. So about the cost of debt due to maturity on existing bonds. Due to maturity, the YTM of one's existing bond is approximately 4.5% based on recent bond data, and the cost of debt is 4.5%. Cost of equity, a CAPM model, or the capital asset pricing model. Formula is equal to risk-free rate plus beta multiplied by return on a market minus risk-free rate. And you can see the index very clearly on the screen. The risk-free rate is at 3.745%, and return on market at 315.38%, and with a beta of 0.1. Cost of equity, and we calculate it and have a result of 34.91%. Therefore, the cost of equity of the Walmart is 34.91%. Tax rate from annual report, effective tax rate is 23.4%. Weighted average cost of capital, WACC, using the capital structure weight and cost calculated both. We can calculate with the input data to have a result at 32.42%, as you can see on the screen. About part 8, forecasting, recent developments and future prospect of Walmart. So, expansion of e-commerce and technology investment. Walmart has heavily invested in its e-commerce platform to compete with Amazon and other online retailers. The company has improved its website, mobile app, and delivery services, including same-day delivery and curbside pickup. Apart from value, these investments have boosted Walmart online sales and customer engagement, contributing positively to its revenue growth. Automation and supply chain improvement. Walmart is investing in automation technologies such as robotics and AI to streamline supply chain and reduce operational costs. The company has also opened automated fulfillment centers to improve efficiency. So these initiatives are expected to enhance profitability by reducing labor costs and improving inventory management. So about sustainability initiatives, Walmart has committed to achieving zero emissions across its global operation by 2040. The company is investing in renewable energy vehicle fleets, and sustainable packaging. The important value is that these initiatives align with growing consumer demand for environmentally responsible businesses and could improve Walmart's brand reputation. Acquisition and partnership. Walmart has acquired several companies to strengthen its e-commerce and technology capabilities, such as Jet.com and Flipkart. The company has also partnered with tech firms like Microsoft to enhance its cloud computing and AI capabilities. So these acquisitions and partnerships have expanded Walmart's market reach and technological capabilities, positioning it for long-term growth. As you face Walmart, the regulatory and legal challenges. Walmart face ongoing lawsuits related to labor practice, wage disputes, and antitrust concerns. These legal issues could result in significant financial penalties and damage to the company's reputation. So about the future outlook, increased scrutiny from regulators and potential changes in labor laws could pose challenges for Walmart's operation and profitability. Competition in e-commerce. Walmart faced intense competition from Amazon, Target, and other e-commerce giants. The company must continue to innovate and invest heavily to maintain its market position. So while Walmart has made significant progress in e-commerce, sustaining growth in this competitive landscape will require ongoing investment in strategic initiative. Supply chain disruption. Global supply chain disruption, such as those caused by the COVID-19 pandemic and geopolitical tensions, have impacted one's ability to maintain inventory level and control costs. future outlook, Walmart's investment in supply chain automation and diversification should have mitigate the risk, but corruption remain concern. Economic uncertainty, inflation, rising interest rates, and economic uncertainty could impact consumer spending and Walmart's profitability. Walmart focus on low price and value-oriented products, positioned it well to weather economic downturns, but these factors could still affect its financial performance. About future prospects, both positive aspect and negative aspect. So we go with positive aspect first. Walmart's strong market position, extensive retail network, and investment in e-commerce and technology provide a solid foundation for future growth. The company's focus on sustainability and automation aligns with long-term trends and could enhance its competitive advantages. Walmart's ability to adapt to changing consumer preference and market conditions demonstrating its resilience, uh, resilience, and innovation. Negative aspect, legal and regulatory challenges, along with intense competition, could hinder Walmart growth and profitability. Economic uncertainty and supply chain disruption remain significant risks that could impact the company's financial performance. So Walmart recent developments such as its e-commerce expansion, automation initiative, and sustainability commitment position the company for long-term growth. However, the challenges such as regulatory scrutiny, competition, and economic uncertainty could impact its future prospect. Overall, Walmart's strong financial condition and strategic investment make it well positioned to navigate these challenges and continue delivering value to shareholders. So for part 9, the last part, conclusion and recommendation for Walmart. So my recommendation for the Walmart stock is hold. Based on the analysis of Walmart's financial performance, recent developments, and future prospects, the recommendation for Walmart stock is to hold. Reason to support the recommendation. First one, strong market position, growth potential. Walmart extensive retail network, strong brand recognition, and investment in e-commerce and technology position it well for the future growth. The company's ability to adapt to changing consumer preference and market trends demonstrate its resilience and innovation, supporting evidence. Walmart's revenue growth 6.7% in 2023 and consistent profitability despite economic challenges outline its strong market position, risks, and challenges. Walmart faces significant risks, including regulatory scrutiny, intense competition, and economic uncertainty. These factors could impact the company profitability and growth prospect in the short to medium term. Supporting evidence, Walmart's declining profit margin from 2.42% in 2021 to 1.91% in 2023, the rising debt levels, debt to asset ratio of 77.88% in 2023 indicates potential financial pressures. So we go to conclusion is that while Walmart's strong market position and strategic investment make it a solid long-term investment, the current risks and challenges suggest that investors should own the stock rather than buy or sell. Investors should monitor Walmart's ability to navigate regulatory challenges, maintain profitability, and sustain growth in a competitive and uncertain environment. So here's the reference list. I take the data from stock analysis on net and U.S. Securities and Exchange Commission and U.S. Security and Exchange Commission on 2022 and 2025, and the macro trends, Walmart long-term debt data retrieved from this link, as I mentioned very clearly on presentation. So that's all of the presentation today. Thank you very much, Sir Manal from Golden Gate University for listening to my presentation. My name is Lê Tùng from Vietnam. Thank you very much for listening. Thank you and goodbye.